Nilesh Shah joins us now. Let's take a conversation forward. We always look forward to our interactions with Nilesh Bhai. Nilesh Bhai, good morning. Thank you for joining us. For an eternal bull like you and me, we would say focus on the bright side. Great things are happening in IT. Great things are happening in some of the cyclical industries like steel and cement. But somewhere, is it time to also get realistic and open our eyes, shake ourselves and say that when you see this kind of an excitement and participation in the IPO market, it is important to remind ourselves that everything that goes up can also come down.
Thank you, Nikunj Bhai, for inviting me over here. And undoubtedly, you have spoken the wise word. The question is, are we in 2008 beginning kind of cycle where a lot of IPOs were coming at exorbitant valuation, especially from infrastructure sector? Or are we at 2007 beginning where markets had run up, IPOs were getting lined up, and for almost next 12 months, markets continued to rise? It's a very, very difficult call to make, but I will hazard a guess that we are somewhere towards beginning to middle of 2007 rather than beginning of 2008, where imminent crash is inevitable. Undoubtedly, in the IPO, number of issues are rising, amount mobilized is also rising. But so far, by and large, quality of IPOs have been fantastic. Retail investors have been participating mainly from a flip-flop point of view, and institutional investors are buying post-listing. So while this is time to be selective in your IPO investment, there could be some IPOs where listing may not happen as per the grey market premium, and that should signal a warning bell. But at the end of the day, good quality companies will still make money for investors.
There is one sector, Nilesh Bhai, where there is absolute boom, that's IT. If you read a headline from Accenture, they're looking at hiring 100,000 employees this year. It just tells you the demand bullishness they have. And there's one sector which has fallen off the radar is Pharma. Both have changed because of COVID. But Pharma is down the barrel in terms of markets and stock performance, and IT is right up there.
I think the difference between IT and pharma has been the valuation. IT stocks were coming on back of low growth and low valuation, and COVID-19 just provided them growth stimulus, which resulted into upwards re-rating. Pharma sector, on the other hand, had seen huge underperformance long before COVID, but just a year or before COVID, they were getting re-rated as other parts of markets were looking expensive. When they entered COVID, they were with reasonably high valuation. COVID did provide a growth support to them, but the valuation barrier ensured that throughout the COVID, they were not further re-rated. They just continued to maintain the valuation. And which is why we are seeing difference between performance of IT sector versus pharma sector. In IT sector, we have seen mid-cap ITs delivering better return than large-cap ITs. In pharma, we have seen selective pharma companies still outperforming broad market. So now onwards, I believe with the re-rating behind us, it will be company-specific story. In pharma sectors, those pharma companies which are able to launch products, which are able to provide, products at competitive prices, they will do well. And the same way in IT, there is a risk of margins getting impacted because of rising wages. We have all seen how startups are advertising about recruitment. So there could be some pressure on IT companies from increased personnel cost.
How does one play the second derivative of IT? Because now whether you work in Accenture or TCS, the wage hike is evident. Startup is trying to acquire talent. IT companies are giving big wage hikes. Tech Mahindra is giving out Mercedes to top performers. There's an IT company which is promising BMWs and Mercedes both. How does one understand the boom in IT will translate into consumer spending, and which are the sectors to buy or stocks to invest in?
So undoubtedly, a large part of our consumption is driven by salaried class. And within that salaried class, there is a segment coming from IT and IT related services. As wage level increases over there, and it is more likely to increase at the bottom of wage earners rather than top. So those people's propensity to consume will be far higher. I think in India, roti kapda makan is the way of spending. Now, at least for this segment of people, roti and kapda was not an issue, but makan could be an issue. So we see there will be increased demand for housing, especially in work from home environment, and you will be using your increased payout to buy a house for yourself. And for last couple of months, we have been bullish home improvement sector. We think real estate will get supported by primary as well as secondary demand. People will buy new residential houses in work from home environment. People will repair and improve their housing. And this is going to create volume expansion for home improvement sectors, right from paints, tiles, plywoods, cables, furniture fixture, electrical appliances, cement, and so on and so forth.
Nilesh, hi, morning. Along with Roti Kapda Makan for the new gen, it's also about Gadi. But, when it comes to the auto segment, of course, that big awaited disruption of EV market in India and how it's going to pan out really. But in the more near term, it's the commodity costs, it's the chip shortage, which are also marring the industry. Do you sense that this is a tailwind which is going to continue to dampen sentiment here, and thereby investors also need to be wary?
So in auto sector, consumer demand will be less of a concern for the time being. The bigger issues will be raw material securing like chip shortages, or the pressure on margin because of rising commodity prices. And over here, my feeling is that at least for next 2 to 3 quarters, these problems are likely to persist. And then each company will have to take a call balancing between consumer demand versus their margin requirement.
Right. Also wanted to understand, Nilesh, given that something very big is happening now with the telecom sector, it seems like we're on the brink of headed into a duopoly. How is it that you're viewing what happens to the telecom sector? And, how should really investors maneuver now within this space? Because for a very long time, they've waited for an incumbent to go out there and, bring about those tariff hikes, which finally seem to be happening because Bharti's managed to bite the bullet and take that call first.
So in telecom sector, as an analyst, we can predict demand, supply, we can predict ARPU kind of thing. But how do you price in regulatory risk? The AGR dues was something which was difficult to price in. The spectrum fees is something which is difficult to price in. Now, that is the story of telecom sector in the past, where analysts were continuously surprised or shocked by the events which were beyond their comprehension. Going forward, one simple rule is that if it's a duopoly or 2.5 player market, then there will be pricing power. And people are addicted to data usage. We are one of the highest data usage countries in the world, and our pricing is the cheapest. Data usage is unlikely to come down as people are addicted to it. Pricing has no room to go down, but to go up as duopoly comes into play. So clearly the future of telecom sector is significantly different from the past. However, we still have to convince ourselves that there will be no regulatory surprise or shock.
Scan into the markets right now, and Pharma today is inching back. IT is pausing, but that really could be pure sectoral rotation. Nilesh, we've seen a bit of a reversal in commodities and global commodity prices, whether it is the whether it is gold or what is happening in crude or way industrial commodities are pausing. Do you think somewhere we need to be cognizant that commodities now could reverse, and if commodity prices they reverse or even if they hit the pause button, A, commodity stocks will come down, B, in general, that's bad news for a lot of industries?
So our view on commodity prices that the exponential rise which we witnessed in last 6 or 9 months is unlikely to sustain. That's the nature of commodity cycle. At higher prices, supply emerges from dormant capacities and demand starts tapering off, eventually bringing equilibrium, which results into commodity prices coming down. This is the nature of the commodity cycle over hundreds of years, and this time is no exception. However, we continue to believe that some commodity prices will remain elevated as demand supply imbalances are likely to persist. In terms of ranking, we believe copper, aluminum, and steel, that should be the ranking for picking up stocks in commodities sector, as copper and aluminum cycle is likely to run longer than the steel cycle.
If we don't see a third wave, and fingers crossed that we should not see a third wave, is there merit in then buying banks? Because most of the banks have said the following, that look, we had problems because of the second wave in the quarter gone by, but things have normalized, but fingers crossed for the third wave. Are banks in a position to get re-rated if we don't see a third wave and when things starts normalizing?
Nikunj, I'm sure you would have read a newspaper article which says that one of the leading bank got about 30,000 crore worth of prepayments. Now, while there is one side of the story about NPAs, the other side of story is prepayments from corporates and from other borrowers, and also the provisioning made by the banks over a period of time. So at this point of time, after underperformance to broad market, we think it is time to be selectively long banking businesses. There will be opportunities in the days to come, especially those banks where credit culture is fine, where provisioning is taking care of their NPAs, and NPAs number can be taken at a face value.
So slightly big picture question, not about interest rates or credit policy this time, but about market cap. We have a market cap of $3 trillion. Now we can debate when we will reach 5, whether it is 5 years, 10 years or 12 years, but we are headed there. So if economy will become $5 trillion, stock markets will also become $5 trillion. What do you think will add the next $1 trillion to India's market cap?
I think the addition to market cap will be driven by, one, the IPOs which are coming. If LIC gets listed, undoubtedly it will add significant to India's market cap. So let me divide even IPO into two parts. One, divestment by the government, which will add to the market cap, especially of companies like LIC. And second will be new IPOs which keep on hitting the market. The second thing which will add will be growth in the existing businesses, where we believe big is becoming bigger and better is the mantra. Some of the larger companies in respective fields, not necessarily large cap, but which are large in respective fields, will continue to gain market share from unorganized sector. They'll continue to grow big, and they will also get re-rated, and hence their addition to market cap will be more than their profitability. The third addition will come again from companies which are coming from new age sectors. These companies are getting listed and market is in fancy of them. Some of them will be successful and they will add one more sector to the existing market cap. So primarily our market cap will be driven by IPOs, big becoming bigger, and new age companies getting listed and creating a new sector.
Hi, Mr. Shah. Good morning. This is Mubina as well joining in. I have a follow-up question on something you spoke about, and that is how you believe that aluminium and copper will really be seeing more of an uptick compared to maybe steel. So there are certain commodities now that will continue to either go higher or stay elevated. My question is, India primarily being a commodity consumer, many India Inc. Companies are commodity consumers. Which ones do you think are going to be most vulnerable to these elevated commodity prices? What sectors could see a hit to their profitability because of this?
So the impact of commodity prices will be across many sectors, but essentially top down, we have to divide them in two parts. Companies and sectors which will be able to pass the cost increases to consumers without impacting volume, without impacting demand. And companies which will not be able to pass cost increases to the consumers, either without impacting demand or without impacting the overall business volumes. Now, we believe automobiles will be probably in second segment where their ability to pass cost increases to consumers will be limited. On the other hand, electrical appliances, wires, cables, real estate, construction, those kind of sectors should be in a position to pass cost increases to the consumers. So you'll have to really look at whether companies have cost ability to pass the cost increases or not.
So elasticity of demand really across the different product segments is what you have to, in a way look at. Mr. Shah, like we spoke about, that a big chunk of the consumption growth is going to come from the salaried segment. Nikunj speaks about how, the IT segment hiring is going gangbusters. You spoke about how, housing sales would improve. We've already seen that in the first half of this fiscal. And in turn, it's being reflected in the way realty has moved up. Very unexpected one that's coming in after a very long time as well, where we've seen a massive run up in stocks. Do you think that these stocks have already discounted for that improved housing sales, or is there more room for a rally there, according to you?
I think housing is a longer term trend. A decade back, it was contributing almost double digit to India's overall GDP. And this is broad spectrum of housing, construction, real estate. Now it is contributing higher single digit to India's GDP. And now stars are aligned for housing sector. Housing interest rate loans, housing loan are having interest rates at one of the lowest level. RERA has aligned consumer and developer interest. Affordability has increased as house prices have remained stagnated. Put all these things together, we believe housing is a longer term trend. And the way to play out is real estate stocks directly, as well as home improvement sector connected to real estate. When you are investing in real estate, be sure that you are backing right promoters, because this sector has lots of issues related to governance. So within real estate, I believe big becoming bigger, better governed company becoming bigger will be the trend, will be the mantra.
Nilesh, have to understand and get in your view on how you're viewing these Indian internet companies. The FANG moment, which was marked by Zomato's listing. Today, of course, are the earnings as well, so all eyes on that. But, next you've got a Paytm, you've got Nykaa, you've got Policy Bazaar. But, again, the other question is whether or not what's left on the table once these companies list, because Max Juice is already out. Irrespective of the listing pop that you see, the valuations continue to become questionable.
So let me accept that we are like blind men trying to figure out elephant about digital companies. Over decades, we have developed ability to value physical asset. Someone puts up a steel plant, and if he doesn't write it off in the first year of spending, we are fine with it because we know this steel plant will deliver value over a period of time, and we are comfortable using the depreciation charges rather than writing off all the spendings. Like physical asset, a company is also creating digital asset. Today, they don't capitalize digital asset, they are writing it off. The value of platform, the value of contracts with hotels which are on your platform, the employee base which you have created, the consumers whom you have enticed to your platform. This is all spending which is not capitalized, but which is likely to give benefit over a period of time. Now, we have to develop expertise on valuing digital asset. It's a work in progress for us. We are also taking baby steps. We have built our model in terms of what a digital platform should deliver on the path to profitability. It's a longer path, it's an uncertain path, but yet we have tried to build a model to figure out where they will be over a period of time. Now, if the quarterly results are indicating movement in that direction, I'm sure investors will continue to stay with digital assets, digital companies. If there is a deviation in that path, the prices will eventually reflect that. So this is one more from a fundamental point of view. But market is also made up of sentiments apart from fundamentals. And in the digital space, either there are believers or there are non-believers. Now, whenever prices will correct, believers will continue to buy, but the non-believers will panic and they'll rush to sell. So the movement on the downside will be far higher as believers will wait for non-believers to sell out and then accumulate. So this is kind of a sector where we will see higher volatility, especially on downside. And here, your conviction about your model will get tested.
Indeed. Okay, Nilesh, great to have you on the show. Thanks as always for taking the time out and speaking with us.